Hello, hello, hello. How's it going, everybody? Good morning, good evening, good night, depending where you are around the world or when you are going to be watching this webinar. Welcome to a Capital Hungry Monday Market Analysis webinar. If you are new here, basically what we're going to be doing over the next 30 to 60 minutes is analyzing the markets in terms of doing some fundamental and technical analysis for trade ideas to potentially execute on gold, XAUUSD, GBPJPY, GBPUSD, EURUSD, USDCAD, and US30 stock market index. We will also be looking at what current fundamentals are impacting the market and some of the major market movers, like looking at individual movement on the US dollar, global equities, Japanese yen, and so forth, as well as looking at what economic data we have on the docket through Asian session and overnight that we can potentially anticipate and use to our advantage that lines up with our technicals and trade ideas across the pairs. Okay? For anybody who has questions about capital hungry resources, educational webinars, and so forth, just check out the description. You have tons of free resources, paid resources, and so forth. Go wild with all that information. There's more than you can handle. You know what I mean? For all of the returning guests, for all of the returning audience, thank you for coming. I see Burner in the audience, Mac already here. Thank you for the support. And let's just jump right into it, shall we? So, some key recent fundamental points that have been in focus is that the Fed had a step back on the aggressive rate hike tone, and Jerome Powell was showing us a more slow and steady approach to the potential interest rate hikes to come for the US. On top of having high inflation for the US last week in terms of the US CPI and PPI data, which is showing overall higher economic inflation from both the consumer perspective and the producer perspective, this led to a bearish move on the US dollar. But this higher inflation is still keeping various asset classes bullish as inflation inflates the prices of all goods within the economy, on top of the greed train of investors and smart money still pooling liquidity into these various asset classes. What I mean by that is you can see that this slow and steady approach by the Fed and the higher inflation led to the equity markets still staying relatively bullish when you look at NASDAQ, US30, and so forth. Oil is still relatively bullish, going back into the $80 a barrel range. I think we even hit $85 a barrel today. We can see gold is still very bullish, holding in a higher time frame range, just sitting around the 1820s and previous intraday highs, while the US dollar is more on the bearish side. So we can see the direct market impact and how smart money is pricing in what the Fed is doing and what the Fed is saying on top of what actual economic data is showing us in terms of inflation. And I did an educational webinar about this, the last Capital Hungry New York trading session. It also turned into an economic breakdown where I fully discuss in more detail what the Fed did from the start of the pandemic, as well as the government working hand in hand, the impact it had on various financial instruments in the financial market, as well as outside of what we just look at trading, the impact it has on us as day-to-day citizens, on our wages, on the dollar value in our pocket, on the cost of goods that we pay for just to be living day in and day out, right? So I gave a full breakdown if anybody wants to go check that out. It's just on the YouTube page. But anyways, so equity markets bought up that dip due to the slow and steady Fed rate hike approach and the higher inflation. The US dollar is in pullback structure with some short-term bears in play as we're having a pullback from the highs. The Japanese yen individually is doing a bullish pullback from the new lows it printed. And all of these pullback plays we're starting to see, like for example, dollar having a bearish pullback from its highs, which we'll look at here in a second, or Japanese yen having a pullback from its lows and so forth. All of this is perfectly reasonable and understandable with the fundamentals that are inducing that and the fact that it's the start of a new year still, right? So as a trader, Yes, you want to understand the economics and fundamentals to the best of your ability. You want to back test technicals that make sense to you and find a way that helps you read the market in the most efficient way possible. That works for you, right? But it's not just that. Another aspect that a lot of traders ignore is market timing, right? And this market timing can go all the way from a higher time frame perspective of understanding the significance of the end of a fiscal year, start of a new fiscal year, end of a quarter, end of a month, and the significance this has in the real financial world outside of trading. And this market timing can also be dissected and zoomed in all the way into lower time frame as a scalper about understanding session opens and closes, when a significant intraday candle is closing or opening, like a 4-hour candle, when you can expect specific timing of volume to come into the market, right, with stock market opens and so forth. Okay, so market timing is very important, and what I'm trying to explain is seeing the dollar as its overall still very bullish in structure. This is the dollar. I'll put it on the 4-hour time frame here. You can see from these lows, ever since May, dollar has been in very nice bullish market structure, right? Buyers continuously printing higher highs. As buyers take profit from the market, it creates these pullbacks to more favorable demand zones and demanded price points, and you get these pullbacks but still end up overall continuing bullish. So as we came to the end of 2021 and 2022, dollar was printing new highs on the higher time frame and intraday time frames. So seeing this pullback that's also fundamentally induced by the higher US inflation and the slow and steady approach by the Feds makes a lot of sense, right? And you can see that this pullback is conveniently going back to retest the previous high points as well, and still maintaining the overall bullish market structure. So having that pullback on the dollar, setting up that order flow for the new year makes a lot of sense. Same thing when you're looking at the Japanese yen here, which primarily as a safe haven currency, as the demand in the financial markets has been in risk assets like in oil, commodities, stock market, and so forth, the Japanese yen as a safe haven currency has been relatively bearish over the last year, right? And you can see it's just been making continuous lows and having these pullback phases or consolidation zones that are very short-lived and end up getting faded out with having more sell orders get collected from better supply zones and sell price points before continuing down with this overall trend, as fundamentally there hasn't been really any reason for higher time frame bulls on the Japanese yen because the market demand has been in equity markets, stock markets overall around the world, has been in oil, these other commodities that have been so bullish, copper, and so forth, right? The financial market's huge. That's another thing. As you start to grow and gain experience, you have to learn to look outside of your bubble. Like most people who trade GJ, they don't really have an interest to just learn about the financial markets overall. But the financial markets is a huge interconnected global web. That includes everything from the real estate market to business acquisitions to banking, trading from like currencies to bonds, commodities, stock markets. There's people out there making millions of dollars trading corn futures. There's people out there making tons of money trading soy futures. You know what I mean? Copper, lumber, and so forth. Like the market is so vast, but once you really learn a lot of core concepts, you can apply them to things across the board. But anyways, the main takeaway that I want people to understand right now is that on the intraday time frames, when you're looking at the Japanese yen, right, I define market structure by price points of interest. So for example, bearish market structure is being respected as long as we remain technically below 88.5 to 89. You might ask yourself, Jeevan, what is the reason for that? From this price point here specifically, very similar to we had this price point specifically to the left, which I'll talk about in a second, is the last price point of interest where you've had a low printed, a pullback from that low, sell orders collected from a better supply zone and price point, and from there you led into lower lows, right? It's just like when you were looking at market structure and you were saying, let's just say this didn't happen yet here. None of this happened yet, right? It's the same ideology here. You have a low printed here, and this pullback here could have easily come up to this last lower high and still been maintaining the overall integrity of the bearish market structure, right? So you have a low printed from here, you drive into lower lows. Even if the Japanese yen dug a bit higher into here, and rejected, it's still respecting bearish market structure. Even though you can draw a trend line and you might be breaking it, trend lines are very subjective, right? But price points are objective. You can't argue price points. You can argue the way you draw trend lines. You could say, well, this is some bearish structure here, we started breaking it. No, Jeeve, this was the bearish structure. No, this is the bearish structure, right? But what you can't argue is specific price points where you can see order flow entering the market that still maintains the overall structural pattern and still has price continuously having sellers, in this case, printing lower lows, right? So from this new low printed by sellers on the Japanese yen, we can see a pullback. You might ask yourself, why is this relevant? Well, when you can understand the individual movement on the Japanese yen or the individual movement on the dollar index, you can directly apply this information to the currency pairs and other correlated trading instruments. For example, the same time dollar had a bearish pullback and was bearish on the intraday time frames after being in a consolidation zone is the exact same time a pair like EURUSD from its low points on the higher time frame had a bullish upside move, or AUD/USD was showing some bullish pullback structure, or GBPUSD from its low points, right? GBPUSD from an intraday low point is also in bullish pullback structure. It's doing the inverse of the dollar movement. You can see the same thing with like AUD/USD. From a low printed below the previous lows, the same time dollar has been softer and flat, you can see AUD/USD is in more bullish pullback structure from the lows, right? Which this pullback structure could easily, if we want to see sellers collect sell orders from those price points, this pullback structure could easily go to 7.5 before continuing down, right? Or we can come back below these lows and continue down. But for the time being, you can see that majority of dollar pairs have been respecting that pullback structure from lows. The reason for that is because of the US dollar's dominance on the global scale. Regardless of what people might think of the US economy, the US dollar historically is still the world reserve currency and primarily the global business currency. Majority of global import and export is still done in US dollars. Oil is still primarily traded in US dollars. Anybody or any country government leader who tries to go against that usually gets X'd out very quick. You know what I mean? But anyways, that's neither here or there. So you can see when the dollar index is doing a pullback from the highs, you can see the correlation in the pairs, right? When the Japanese yen is doing a bullish pullback from the lows, you can see a pair like GJ is doing the opposite. From its intraday highs, it's having some more exhaustion, right? So I just want people to understand that because we can use that correlation to our advantage. But before we start jumping into the expectations of price movement, I just first want to go through what economic events we have on the docket because we do have some important ones. So for the 17th, not too much data through the Asian session, but we do have that's going to be impacting GBP overnight. We're looking here. So impacting GBP pairs overnight, we do have labor market data, unemployment rate, and job count change, right? I personally think that this labor market data is going to start to level off and show us some more neutral to even potentially weaker data, right? Then we have the ZEW economic sentiment and current conditions for Germany. This is at 5 a.m. Eastern at the 4-hour candle close and at Asian session close, which is going to have a short-term impact on euro pairs, okay? Milk auctions, not too important for what we're trading here. For USDCAD, some housing figures are going to be important 15 minutes into New York session open. And then we just have some New York Fed manufacturing index data and some medium-term housing market data for the US through the New York session. So just keep that in mind, all right? Now, if everything stays pretty much status quo, you can see, let's look at the dollar here and look at the Japanese yen individually in terms of the price action and market structure. And you can see we had a very strong seller supply zone here where sell orders were collected in the market. At the same time, buyers are taking profit from new intraday highs printed. That created this aggressive pullback. You can see very strong bearish engulfing candles breaking below that order block, respecting that resistance zone as buyers are taking profit because of the fundamental catalyst stated of Jerome Powell saying they're going to be slow and steady with rate hikes, and obviously having the higher US inflation, which are both bearish factors for the dollar but are bullish factors for the other asset classes like oil, equities, gold, and so forth, right? So in my opinion, as long from a technical perspective, as long as we don't have a full correction of this impulsive drop, it still looks like sellers are in play on the dollar, which means I can still expect some pullback buys on GU, EURUSD, and the dollar pairs accordingly. In my opinion, if we don't correct this move, if we come back below 95, dollar should come back down to revisit these lows and even come down to potentially 94 before potentially seeing a more aggressive bounce. Because in my opinion, this pullback on dollar going down to 94 would also line up with that pullback I was talking about on GBPUSD. When you're looking at GBPUSD and overall the market structure, you can see the last price point of interest on the higher time frames on GBPUSD that's maintaining bearish market structure is 1.38 flat. Remember, we're going to use the same ideology here. You're having consecutive lows printed. You had lows printed by sellers here at the start of October, which was the start of Q4 before 2021 ended. At the start of Q4, you entered a pullback phase where you came to 1.38, previous price sensitivity area to the left as well, same supply zone. And from here, you really had sell orders enter the market with really minimal pullbacks until these new lows have been printed, right? Seeing this deeper pullback phase when understanding the way dollar pairs behave is completely normal, especially seeing it a little bit larger as we're starting a new fiscal year, setting up the order flow for a new year. So in my opinion, that potential bear on the dollar, as long as we still maintain some of this intraday bullish market structure, GBPUSD could easily still come up to 1.38 before seeing sellers really back in play in the market. This same correlation is also very evident when you look at EURUSD on the higher time frames here. EURUSD, this was the last previous low point. Now, instead of having pullback sells here, you had the second phase of the market. The market can only move up or down in two ways, right? In bearish market structure or bullish, you have, let's just talk about an example in bullish market structure, right? And then I'll show you the exact same example with bearish. You have buyers enter a potential trading instrument from a low favorable price. This volume of buy orders entering the market pushes the price of that asset class up, which we observe as technical bullish candles being printed, right? Now remember, the whole point of trading the markets is to make profits. As these buyers have extended from a specific low point to reach a significant high or supply zone where they can look to take profit, this is what starts to create pullback structure. as the buyers take profit, for them to get relieved and be able to exit out of the market, sellers have to jump in hand. This exiting of buy orders and sellers jumping in hand creates pullback structure, where then the buyers made their money, the sellers who jumped in on that pullback also made their money, and then buyers jump in again from more favorable demanded price points, which starts to create a trending market. Then you at least revisit your previous high and potentially have enough buy order to break out higher, right? Or at a significant high, their buyers might want to extend up further, which we see get created as a technical consolidation zone. I personally dissect this as order flow collection, and then you see this consolidation zone, and instead of having a pullback, you consolidate and just break to the upside and continue with the trend. Either having impulsive moves, pullbacks, and continuations, or consolidation zones and breakouts is really the simple way markets trend. And that is the order flow movement behind the scenes. For example here, when you zoom out and look at GJ and really zoom out, that's all you're going to see when you really break down the price action and market structure for the most part in this trending bullish market, right? When you keep it very simple, that's what you see. Buyers print highs. At those highs, you have some profit taking that goes to a more favorable demand zone and more buy orders get collected in that area, or you break to the upside, consolidate, break out, and continue that trend, right? You can see that this same thing is very evident here on EURUSD. So EURUSD, this bearish market structure has been respected, but you have a combination of that market structure. You have impulsive drops, pullbacks, and so forth. You have consolidation zones and impulsive drops. And here you had a consolidation zone, but a deeper pullback as we're in the start of the new year. But overall, you're really identifying the market structure that way. Here, you have exhaustion by sellers and buyers jump in the same time dollar softer, but that's evident because you break to the upside of the consolidation zone. But overall, the market structure is bearish, and this pullback can easily dig back up into that same order block and supply zone before continuing down, right? So bearish market structure on EURUSD is being respected at around 1.55. EURUSD could easily come up to 1.55, 1.16, and even though it might be breaking a trend line you draw, it's still respecting bearish market structure. It's still respecting the higher time frame bearish trend. Okay? Does that make sense for everybody? Okay? So I just want everybody to understand these correlations before we jump into these trade ideas right now, because this is going to be very important to understand, okay? That we are looking to play some short-term continued weakness on the dollar, and also when I'm looking at the Japanese yen, I can easily still see some yen strength to come up to and this is the 4-hour chart on the yen. I could easily see some short-term strength on the yen to come up to 88.589 and still be respecting bearish market structure before making our way back to the downside, okay? So I'm looking to play some short-term bears on the dollar for the time being, going at least back down to these lows, and some short-term buys on the yen, which would go to retest better sell points before continuing with the overall higher time frame trends on these individual currencies, which Japanese yen holds a lot of weight as a safe haven currency. Dollar holds a lot of weight as the world reserve business currency. Okay, so when we're looking at a pair, and we're going to go through the dollar pair analysis first now. GBPUSD, EURUSD, USDCAD, because we understand we're trying to play that dollar weakness sentiment and also have some potential further confirms we can use to our advantage, okay? So, GBPUSD, these white lines are higher time frame historical key levels. You get great respect to these price points. The gray boxes are just some medium term zones, right? But when you're looking at the overall structure, the same time dollar has been bearish, GU on the intraday time frames has been buyers consistently printing intraday higher highs. But you can see from this high printed, we're starting to enter a bit of a pullback phase, right? And even when you're looking at structure on the higher time frames, or you're looking at structure on the lower time frames or the 1 minute chart, it's all the same shit. It can be simply dissected to what I am communicating here. Doesn't matter if you see the structure on a 1 minute chart, doesn't matter if you see the structure on a yearly chart or on a 4-hour chart. The way the transactions occur between buyers and sellers is the exact same. This is because in the modern markets, with the innovations of technology, a good chunk of market trading is automated, and you have constant transactions between buyers and sellers across time frames across the world around the clock. This prints the waves of price action we see on the lower time frame or on the intraday time frame or on the higher time frame, on top of the ever-changing economic events, fundamentals, and so forth. You know what I mean? But anyways, on GU, we could easily come back to this previous high at 1.36 and still be intraday bullish. What would signal a lot more buyer order flow would be getting a break above and continuing back to the upside here to revisit these highs. Yes, exactly. Like Berger said, smaller ripples and bigger waves. The smaller time frames are just a fractal of the larger time frame before it. You know what I mean? So when you can understand the majority of them, you can adapt accordingly. But anyways, so on GBPUSD, I'm still in a bullish bias. I'm either looking for pullbacks to 1.36 buys, holding above 365 buys, or the breaks back above 3.7 buys. As long as US dollar stays soft, we continue to respect this bullish market structure and bullish trending market with stronger bullish price action and bullish trend overall, buyers continuously printing higher highs. And as long as we remain above the previous intraday high at 3.6, I'm still looking to play this bias. This is my main bias. This is if that dollar weakness continues. Now, obviously, we are not magicians here. We cannot always fortune tell exactly what's going to happen. This is my main bias. The only way I would adapt to sells are in two ways. One, if we break below 1.355 and dollar buyers come back into play. Or two, if we make our way up to 1.38 area, which is around this key level here, which that is retesting this previous supply zone and seller zone here. So I would only see sells if we, one, dig our way up to here and start to get rejection confirms, or two, break below the previous little intraday high here. My main bias is those potential buys. What I'm looking to do is the same thing, where I'm generally just marking off some market structure and pullback from the lows. And every time dollar is in that bearish pullback structure or softer, I play this bullish pullback structure accordingly. And you have to understand, as a scalper or day trader, intraday trader, some of this pullback structure can last a month, can last 2 weeks, can last multiple days or weeks. So you don't want to be fighting the market during that. You just want to adapt accordingly. Then when you get the confirms of dollar strength back in the table, the confirms of rejection and breaking that pullback structure, then you can see you have really clean cut sells playing back with the higher time frame trend, where that can also last a period of weeks and months too. But as an intraday trader and scalper, if you don't adapt to these market waves accordingly, you're just gonna burn yourself. You know what I mean? So right now, I still see, as we're holding above this 3.6 area, that we can easily still have this bullish structure continue and dig up to these high points at 1.38. And what you have to understand with a pair like GBPUSD or any other dollar pairs is, before you see the sellers come back into play and before you see the clean cut rejections at a supply zone, you have multiple retests at these areas. You have like, you can reject and possibly consolidate at these areas multiple times throughout the week, getting triple tops, 5 rejections in that area, right? So you can understand and adapt to having some patience. It's not like you get this first sign of rejection and it's like, oh my god, I missed the sells, it's gonna melt. It's like, no. Understand and backtest how this pair behaves, how you get the rejections from the lows and pullback structure, how you start to retest the sell zone and how many rejections you get there on average, right? Most of the time, majority of the time, it's not just a one rejection drop and melt. You get multiple rejections at those high points, right? So anyways, still looking to play that short-term bullish bias on GBPUSD. We can just see we're in some bearish pullback structure from these intraday highs printed. On EURUSD, similar idea. As long as what we had right now happen was an order block in consolidation zone, a break to the upside of the consolidation zone, and so far looking like a pullback retest, okay? On EURUSD, as long as we hold above this consolidation zone and the US dollar is still relatively bearish, which is the bias we are looking to play, and we don't have any reactive headlines that shift that sentiment, because something else I forgot to discuss from a fundamental aspect is that in terms of reactive headlines, there hasn't been much. The market has been more closely following central bank policy positioning. A lot of the fear regarding like Omicron or COVID overall, it's been priced in over the last 2 years. It's been digested. It did its job in the financial markets of causing the crash and fire sale prices and making the rich even richer, right? There hasn't been really too much in reactive headlines that's been causing any market fear or causing any drop on the stock markets and so forth, right? We would really need to have global lockdowns again for that to happen, right? So a lot of the stuff such as trade war tensions, they've been pushed to the back burner for a while now. Brexit issues have been pushed to the back burner. Everything in mainstream media as well as headlines have just been around vaccines, right? Markets have been more following central bank policy positioning. When are the Feds going to raise interest rates? What is inflation looking like? How has economic data been rebounding and so forth? You know what I mean? So anyways, on EURUSD, as long as we hold above 385 key level, I'm looking for buys to target these highs, breaks above 1.144, and the safest buys above 1.147. This is my main bias. Still looking to play that short-term dollar weakness sentiment, getting a pullback from these higher time frame lows, understanding this pullback lines up with the setup of the order flow for the new fiscal year, right? I would only switch out of this bias and adapt to the sells in 2 ways. One is if we dig up to this previous supply zone and previous lows at 1.55, which we're not even close to doing so yet. Then we can see this is the area where we're going to be retesting higher time frame bearish market structure. Or 2 is if dollar buyers come back into the table and we break and snap back below the consolidation zone. Otherwise, my main bias is the buys on GU and EURUSD at those price points given. Now, if on a pair like GBPUSD and EURUSD, where I'm expecting dollar bears and the dollar is the secondary in the quote, what do you think my bias short term is on USDCAD? Where on USDCAD, we have a double whammy here, right? We have very similar price correlation to the dollar index, where we're getting a break below this price point of interest that was maintaining bullish market structure. This was the last price sensitivity area at 1.265, where we had a high printed by buyers, a pullback, more buy orders collected that led into higher highs. You can see it took multiple revisitations of this area and dollar weakness to finally start to break below that price point of interest, right? Also, the fundamental double whammy on USD CAD for the short-term bears and playing some potential sells is, one, we can see that we have the dollar index in potentially bearish pullback structure, and also did very similar repetition to USD CAD of breaking below this price sensitivity area and having a deeper pullback from its highs. Number two, the higher inflation on the US economic side is a bullish fundamental factor for oil. Oil is at trending bullish since the year crash, obviously. Oil is at $85 a barrel. A positive crude oil is also a positive for the Canadian dollar. So when I'm looking at a pair like USD CAD, I was expecting a deeper pullback for this new week, but it doesn't look like we're getting it. If we get a double top at 2.5, even a retest of previous lows at 2.6, and a break below 2.5, I'm looking to play USD CAD sells. Okay? Now, if we're looking to play that dollar weakness and higher US inflation, which keeps asset prices inflated, and we have a bullish bias on GU and a bullish bias on EURUSD, but a bearish bias on USD CAD, how would all this same information I'm giving you translate to our potential bias on US 30 stock market index? If inflation is still high and the Feds want to take a slow and steady approach to interest rate hikes and the US dollar is bearish, that means I'm more in a bullish bias on US 30 stock market index. As long as we hold above this double bottom area at 35,600 flat. Because even though we had this bit of a pullback, again, ask yourself these questions. Where is this pullback coming from? Well, it's coming from new all-time highs printed by buyers. When is this pullback happening? It's happening really at the start of 2022. This more just looks like profit taking by buyers to create a pullback on the stock market to give you better prices to continue right back up bullish. Because what have you been seeing with the trend on US 30? Every time a high is printed, you have an aggressive pullback or a revisitation to those highs at least. And either you break into those highs or reject, but every time all you do is create a pullback and continue trending overall bullish, right? And all of those pullbacks either come from new highs being printed or rejecting previous highs and not having enough order flow in the market to break higher at that time. So on the US 30 stock market index, that same concept of dollar weakness, as long as we hold above 35,600, I'm bullish. Buys above 35,850, buys above 36,100, buys above 36,500, looking to play the bullish trending market, slow and steady rate hike approach by the Feds, which is still bullish fundamental confirm as investors love low interest rates and inflation for their stock market investments, and playing the overall bullish market structure, looking to target these previous highs at 37K. Main bias with the weaker dollar, higher inflation, slow and steady approach by the Feds on the stock market is bulls at these price points of interest. I would only be shifting out of this bias or looking for sells in two ways. Number one, either we break below 35,600 technically and have any market fear evident from a reactive headline standpoint. Or number two, we make our way back up to 37K and might not have enough order flow to break above the previous highs just yet and get a rejection and pullback from the previous highs like we've seen many times before. Otherwise, this is the main bias. Now, if we can see asset classes like oil and US 30 are bullish on the inflation as well as bullish on the weaker US dollar, what do you think the fundamental bias is for the asset class that is gold? Quick pop quiz. Without even looking at the chart on gold, fundamentally, if inflation is still high, if the Feds are keeping interest rates low, if other asset prices and commodities are bullish, what is the expectation of gold? Bullish, buys, up, right? So we can see that has been very evident as well to start off the new year here. From this structure, from these lows, we've been trending more bullish with the higher inflation, because gold fundamentally is an inflation hedge for investors, but not just that. Economic inflation itself inflates the price of all goods, services, everything within the economy, right? This higher inflation is great for investors in smart money because it keeps all their asset prices up, right? But it sucks for us, the consumers, because our regular consumable cost of goods goes up, right? But anyways, that's just a quick little fact, you know what I mean? I've done tons of webinars on the educational aspect behind that. So we can see that this pullback, after collecting more buy orders from this demand zone around 1789, right, 1790s, we've had a strong bullish run. But we can see clear-cut rejection and failures to break these highs for the time being. But remember, the market can only move up in two ways. So when you're really looking at this hourly structure here, what have you been seeing happening? Keeping things very, very simple right now. You've been seeing buyers consistently print intraday higher highs. And from these higher highs, you've had some short-term pullback phases that go to collect more buy orders in the market before continuing higher. Except here, we're starting to enter a higher time frame consolidation zone, still respecting this 1816s and 1820 demand zone. Okay? So from a technical perspective and fundamental, as long as we hold above 1815s, bullish market structure still being respected. You could say, but wait, Jeev, I drew a trend line and we broke the trend line. How come we're not seeing sells? Because remember, trend lines and zones and so forth, that's all subjective to how you perceive the market. But price points are objective. You can't argue the rejections at 1815 here, and you can't argue the rejections at these 1828 price sensitivity area. This cannot be argued, right? But fundamentally and technically, we're still trending bullish on the higher time frames and intraday time frames. We just don't have enough buyer order flow and buyer volume in the market to break above this significant rejection zone. All I'm seeing and all I'm assuming is as long as we don't break these consolidation zone lows, is that this is buyer order flow collecting in the market to potentially revisit these highs and break higher. Does that make sense to everybody? Right? This can be seen many, many times before. Let me give you some great examples when you're looking at gold here, right? This is a great example of some bullish trend, right? You can see a double bottom here, which shows you sellers exhaustion, buy orders entering the market. Then you see buyers printing highs and this overall very repetitive structure, right? Here you can see you entered a bit of a consolidation zone instead of having just pullbacks and highs being printed by buyers, right? But this is the overall broad bullish market structure. As long as you didn't break those consolidation zone lows and you maintain the overall bullish market structure, you can see eventually you break your way to the upside and continue bullish, right? This concept of dissecting market structure can be taken to anything, can be used on any trading instrument, okay? So all I'm seeing here on gold is a higher time frame consolidation zone, right? Very indecisive price action between this consolidation zone, but clearly not enough seller order flow to break the bullish market structure, which is maintaining above 1815's area. As long as, in my opinion, we hold above 1820s, we should be starting to make our way back to the upside here with the safest buys above the consolidation zone. Okay? So, on gold, I'm in a bullish bias with higher inflation, slow and steady rate hike approach by the Feds, bullish market structure on the intraday time frames, weaker US dollar. If we get a pullback to 1816 buys, breaks above 1820 buys, breaks above 1824, breaks above 1828 buys. This is my main bias based on those fundamentals and technicals, okay? The only way I would shift out of this bias and jump in gold sells is I'd need to see intraday candle closures below 1812 to show me that there's not enough buyer order flow to break higher. Intraday closures below here shows me we're going to enter a pullback phase on gold instead, which can see me come to retest this previous high and price sensitivity areas of interest into the 1808s and 1803s. But otherwise, this is my main bias. Okay? Now, we went through analysis on GU, EURUSD, USDCAD, US30. Dollar index was the main confluence as well as the fundamentals stated. Now, GJ, okay? When we're looking at GJ here, you can see we have some very, very similar repetition. These are higher time frame highs printed at 158, right? You can see rejection in roughly the exact same area, and you can see even similar price action. You had buy orders collected from a 149 demand zone. From 149, you really have clean-cut price action all the way up until that price sensitivity area of interest. From this price sensitivity area of interest, you start to enter bearish pullback structure the same time that Japanese yen is holding some bulls. When you go look at the Japanese yen mid-October, you're going to see it was also short-term bullish, which I'll show you in a second, right? Here, you're getting this double top, and you're starting to see sellers printing intraday lows, entering this pullback phase here on GJ. Very similar fundamental repetition and technical repetition taking place with clear-cut price action movements of order flow at same price points. The buy orders in the bullish run was collected from the same demand zone. The potential rejection and buyers taking profit is from the exact same price point as well. Okay? So, like I was saying here, mid-October, Japanese yen, mid-October here. You can see the yen was in this bullish pullback structure, even into the end of the year, right? Same thing now with the expectations the yen can come up to 88.5, 89. All right, so on GJ, let's zoom in even more and look at the structure. When we're looking at this intraday bearish market structure, you can see clear-cut rejection by buyers and buyers' exhaustion at these highs. What this shows me is that in these areas where we have been collecting buy orders, there hasn't been enough buyer volume to break above this price point. That's why we're getting deeper pullbacks, okay? But we're having sellers consistently now overall printing deeper lower lows with very clear-cut rejection at these highs. So when I'm looking at GBPJPY right now, if we double top at 156.6 and come back below 155.5, I'm looking for sells, 156.2 break, and 156 sells. Intraday and scalp plays to target these lows. Just like you would have these pullbacks, but then sellers consistently go back down to the previous low and lower. Back down to the previous low and lower. Pullback, back down to the previous low and lower. I at least want to see if we don't break above this significant price point of rejection around 156.5 to respect this bearish corrective pullback structure the same time the Japanese yen is holding some strength, and at least go to revisit these lows. Okay? The only way I would see potential buys on GJ at this point in time is either if we come all the way to these previous lows and fail to break, creating a double bottom, which occurs many, many times before, right? You fail to break the previous low, you have an aggressive bounce, you can take advantage of that. But for that to happen, I'd also need Japanese yen weakness, or if we break above 156.8. Otherwise, this is the main bias, okay? So everybody, the webinar has been going on for around 45 minutes now, almost an hour. We went through some fundamental points in focus. We went through what economic events we have on the docket. We went through that fundamental impact on global equity markets, as well as individual main power currencies like the Japanese yen and dollar, and the overall impact on investor behavior and market sentiment. We did higher time frame and intraday analysis across pairs with trade ideas labeled out, both fundamentals and technicals broken down. All right. If you guys enjoy this type of content and find it very informative and you'd like me to do it more often, make sure you send a like, turn post notifications on, and if you can do me a favor and you enjoy this content, make sure to follow all of your Capital Hungry free resources, okay? That includes the Capital Hungry YouTube page itself, the Capital Hungry News Twitter, right here. All of these are linked in the description below, okay? You also have tons and tons of webinars at your fingertips. I also created playlists here. 1 minute breakdowns, which I started doing recently for everybody with low attention span. Self-development webinars, societal rants, and so forth. Educational trading webinars. Individual market analysis. Monday market update webinars. Live New York trading streams. Right? You can see just over the last period of time, we've already done so much different stuff here. Right? Tons and tons and tons and tons of educational webinars on the YouTube page. If you enjoy this content and want it more frequently and want to pay for my value, education, and knowledge, then you can come join the Capital Hungry private channel, where we do these webinars 5 days a week, on top of 5 New York scalping sessions a week, weekly recap webinar, weekly psychology webinar, economic events sent every week, political events and so forth, chart updates, access to a Capital Hungry news terminal and newsroom, access to a Capital Hungry crypto newsroom, access to key level price alerts, session open alerts, session open and close alerts, market update monitor. There's way too much stuff for me to describe, but that is $3 a day or $110 a month, and I guarantee you will learn more in the private channel than any other Miami marketer or Forex guru or general random marketer on Instagram. And I guarantee you will learn more than what you know now. You know what I mean? But anyways, besides that quick little advertisement plug of me, make sure if you check out, I've been talking too long now, can't even speak, getting tongue twisted up. Make sure you check out all the resources, free and paid. Check out Dominion Markets if you're looking for a broker. Check out all of your links in the description and on the screen in front of you. I'm out of here. Thank you all for attending, and I'll see you all on Wednesday. I'll be doing some more 1 minute breakdowns and so forth, so make sure you guys check those out when I upload them. Everybody take care.